Hi everyone, welcome to Anujindal.in. Today we are going to take some more questions on finance for RBI Grade B. This is day 6 and we are going to take two numerical questions from accounting ratios. Now these questions can be used as model questions because similar questions, similar quality and similar level of questions have been asked in the past from accounting ratios. I see that a lot of students have been confused as to what kind of questions do we need to do, what level of questions that we do we need to practice from accounting ratios. So these two questions will give a very good idea, and there will be a total of 8 to 9 questions, and they will help you understand what kind of questions can be asked. So let's start with our first question. The question is authorized capital, paid up capital, stock, term loan, contingency reserves. So a lot of figures have been given in the books of the firm, from the books of a firm, and we need to find out certain ratios. So I expect that you can pause this video for a while, go through all of them. Now the good thing, or the in fact the confusing thing here, is that they have not been divided into assets and liabilities. So you find assets here on the left hand side, and at the same time you see some liabilities like term loan. So stock is an asset and term loan is a liability. That means the figures are all mixed up, and therefore it becomes a lot more confusing. So let's come to the next slide and see what are the questions. The first question is NWC, which is the net working capital. So we have to find out the net working capital. Net working capital is current assets minus current liabilities. Let's go back to the previous slide and see what are the current assets and current liabilities. Current assets here are stock, which is worth 200. Then we have debtors, which is worth 100, and then we have advance tax paid, which is also 100. So we have a current asset total of 400. On the other hand, what are the current liabilities? Current liabilities are sundry creditors, very easy, 150. Per operative expenses of 50 are also current liabilities because they are current expenses of a recurring nature. And then we have provision for tax of 100, those are also our current liabilities. So our current liabilities comes out to 300. So our ratio or current asset minus current liability would be 400 minus 300, that will be 100. So the answer for this question is C, 100. So the answer is C, 100, that is net working capital of the firm. Let's come to the next question. The question is, we have to find out current ratio of the firm. It's very easy if you have found out the first one, and if you have not found out the first one, then you cannot find this also, because net working capital is current assets minus current liabilities, and current ratio is current assets upon current liabilities. So here the ratio is going to be 400 upon 300, which is going to be 1.33 is to 1. So our answer is D, 1.33 is to 1. The third question that we have is debt equity ratio of the firm. This is what we have to find. So this is a very tricky term. There are a lot of interpretations that you can make from debt to equity ratio depending upon the question. So let's see what exactly debt equity ratio here comes out to be. Debt here is long term debt, and equity is preferred stock plus reserves plus normal equity. So let's come back to the previous slide where we had all those figures. So we have to see long term debt as well as equity. What is the long term debt here? Long term debt here is term loan worth 200. Let me remove this. So long term debt here is term loan worth rupees 200 and loan from friends worth rupees 50. So that comes out to be 250. And then we have equity that is preference. Sorry, we have where is the equity? Paid up capital is 100. It includes paid up capital, which is the normal equity. It includes preference shares, which is preference stock, and it includes reserves. So contingency reserves are not going to be included. So here we will have 250 upon 100, that is 2.5 is to 1, and that is none of these because it's not there in the answer choices. We'll also come to that. Now let me tell you why exactly contingency reserves are not a part of debt to equity, so that you are clear with every kind of question that can be asked from this. Now in debt to equity, you have debt is long term debt, very clear. In equity, you have either equity which belongs to the shareholders, normal shareholders, preference shareholders, and then you have reserves. Now, what kind of reserves are included and what kind of reserves are excluded? That is important. The reserves which are included are general reserves or any kind of specific reserve which can be distributed as dividend, which can be distributed as dividend. Any kind of reserve which is specific in nature, like contingency reserve here, which is specific in nature. Contingency reserve is a reserve which is created in order to take care of any contingency, any contingent liability, any liability in the future that might arise. So to take care of that, you have contingency reserve. So it is very specific in nature, and therefore it cannot be distributed as dividends in the organization, and therefore it is not a part of debt to equity ratio. Let's come to the next question. Very easy question, this one. If 360 days are assumed in a year, debt collection period is how much? So debt collection period is total debt, the total debt that we have, that is debtors, upon total sales that we have, and we multiply it by years, number of days in a year. So normally it is taken as 365, but here it is mentioned 360 specifically, so it is going to be 360. Debtors we have 100, sales we have 1000, and we have 360 days in a year. So the answer comes out to be 36 days. 36 days is the debt collection period. Even if you don't know this answer, even if you don't know how to calculate, you can actually figure it out, because there are debtors which are a multiple, or which are a clear division of sales. Sales are 1000 and debtors are 100. So we know that 36, if 360 is the number of days, it is going to be a division of 360. So either it is going to be 36 or it is going to be double of 36, that is 72. So that way you can actually eliminate a lot of choices here. The next question that we have is stock turnover ratio of the firm is how much? So stock turnover ratio of the firm is total stock that is there in the firm, that is given as 200. If you go back to the slide, so we'll see that the stock is 200, and then we have turnover. Turnover is sales, which is 1000. In stock turnover ratio, the important thing to remember is turnover comes up whereas stock comes below. So the answer is 5. Stock turnover ratio of the firm is 5. Let's come to the second question. The second question also has certain figures, both assets as well as liabilities. The good thing here is that we have been given a clear division of both assets and liabilities. So we have assets on the right hand side, whereas liabilities on the left hand side. The first question here is tangible net worth of the firm, TNW of the firm, will be how much? So it's important to remember these short forms also. TN worth is tangible net worth. Now net worth is assets minus liabilities. Tangible is the assets which are tangible in nature. A very important question. Let's come back to the previous slide and see what is the assets and what are the liabilities and what are the tangible and intangible. So a good thing here, a thing that you need to remember is that profit and loss debit balance, whenever it is given, you need to move it towards liability side. So you have profit and loss debit balance given here, rupees 15. So you need to move it to liability side and make it negative. That will make it easier. So you need to do that. The second thing is preliminary expenses are intangible expenses. Goodwill, patents, copyrights, preliminary expenses are all intangible expenses. They are not tangible expenses. So you use this information in this particular question, and tangible net worth would be so the assets are 215, and then you remove 15 and 40, that is P&L debit, and 40 which is your preliminary expense. So the answer comes out to be 160. The next question is current ratio of the firm. Current ratio is current assets upon current liabilities. So current assets are cash in hand, inventory, sundry debtors, advance tax paid. Shop, land and building are not current assets, they are fixed assets. At the same time, P&L debit balance that has gone to the liability side, that is not a current asset, and preliminary expenses are also not current asset. So here current assets come out to be 370, and then we have current liabilities. Current liabilities are 270, which are outstanding cash credit 200 rupees here, outstanding cash credit 200 rupees, and then you have sundry creditors of 50 rupees. So both of them are, and then you have advance from customer. So all three are a part of current liabilities. So the current liabilities comes out to be 270. So 370 upon 270 is 1.35 approximately. So our answer is 1.35 is to 1. That's all for this lecture. I hope you liked it. I have covered a lot of questions related to these two accounting ratios, and try to answer some good questions so that you have a clear idea as to what kind of questions can be asked in the examination based on accounting ratios for RBI examination. I'll be coming with more questions on finance as well as ESI every day for you so that you can prepare well on your own related to RBI examination.